Imagine for a second that your absolute biggest business expense, it skyrockets by 85% practically overnight. Just picture that.
Yeah, that is usually a complete death sentence for a business.
Right. Like if you're running a bakery and the price of flour nearly doubles, or, you run a logistics company and diesel fuel does the same.
By all conventional business logic, you should be staring down the barrel of bankruptcy right there. The math simply stops working.
Exactly. But instead of folding, what if you somehow managed to walk away with nearly $92 million in pure operating profit?
It sounds impossible. I mean, it's the kind of scenario that usually ends with a frantic CEO slashing budgets, grounding operations, and basically begging creditors for a lifeline.
But the situation we're looking at today completely flips that script. Welcome to this custom-tailored deep dive created specifically for you.
And we've got a fascinating one today. We are analyzing an absolute masterclass in how you don't just survive an external shock, but how you structurally insulate your business.
Yeah, so that a crisis like this merely dents your armor instead of, piercing your heart. Our mission today is to decode how a major global airline navigates extreme turbulence.
Yeah, pun intended, right.
Right. We're looking at a very specific, incredibly revealing set of sources. We have the Q2 2026 earnings call transcript and the financial summary for Copa Airlines, ticker symbol CPA.
They are one of Latin America's premier carriers. They operate out of this massive, highly strategic hub in Panama.
And look, we are not just going to read you the spreadsheet here.
Definitely not. Whether you're an investor evaluating resilient business models, an operator trying to build a strategic moat, or just someone insanely curious about global travel mechanics, there is a real blueprint here.
Absolutely. We're going to examine how an organization builds operational leverage, meaning how they set themselves up so that when things go right, they win big.
And when things go horribly wrong, like an 85% cost spike, they still manage to stay in the black.
Okay, let's unpack this by looking at the headline numbers first. Because on the surface, they tell a tale of two entirely different realities.
They really do. If you only look at the top line, the money coming through the door things looks spectacular.
Seriously spectacular. Operating revenue jumped 25.7% year over year. They pulled in a massive $1.1 billion.
Wow. Over $1 billion in a single quarter.
Yeah, passenger revenue alone crossed that $1 billion mark. That is just an enormous influx of cash.
But, then you glance slightly further down the income statement to the bottom line, and the picture shifts dramatically.
It's a harsh reality check. Their operating profit was $91.7 million, which gives them an 8.7% operating margin.
Now, an 8.7% margin in the notoriously difficult airline industry isn't terrible, but here is the catch.
What's the catch?
That margin actually decreased by 13.1 percentage points compared to the exact same quarter last year.
Ouch. 13 points is a massive drop.
It is. And their net profit, it came in at $68.2 million, which is $1.67 per share.
So that represents a 53.9% drop year over year, right?
Exactly. So we have this massive divergence here. You have a 25% surge in revenue, but profits are literally cut in half.
The immediate question for anyone holding this stock is why? You have $1 billion coming in, but you are keeping significantly less of it.
The simple high-level answer is that the cost of doing business went completely through the roof.
But before we get to those costs, I think we need to understand why that revenue was surging so hard in the first place.
Yeah.
Because it wasn't just ticket price inflation.
No, it was volume. Volume is the key here. To understand how they generated that $1 billion, we really have to look at how airline capacity and demand are measured.
Right. Management highlighted two critical metrics in this call. Let's break them down.
First, you have available seat miles, or ASMs, which grew by 16.5%. And then revenue passenger miles, or RPMs, which grew by 15.7%.
Let me just translate those Wall Street terms for you, pulling from the industry glossary we have in our sources. The easiest way to visualize this is to think of a restaurant.
I love this analogy. It makes it so clear.
Yeah, so available seat miles, the ASMs, represent the physical size of your restaurant. It's the total number of tables and chairs you have available for customers on any given night.
Right, so if you rent the space next door and knock down the wall and add 20 more tables, your ASM goes up.
Exactly. Now, revenue passenger miles, the RPMs, represent the actual customers who walked through the door, sat at those tables, and actually ordered a meal.
That is the perfect visualization. So translated through that analogy, Copa basically expanded the physical footprint of their restaurant by 16.5%.
Which is huge. They added a massive amount of physical capacity to their network.
But expanding is always a huge risk. Like, if you build it, will they actually come?
Right, you don't want empty tables.
Exactly. And the RPM metric answers that. The customers absolutely showed up. The number of people actually sitting in those new seats paying for flights grew by 15.7%.
So they built a significantly bigger restaurant, and they successfully filled the tables.
They really did. And we really need to pause and just extrapolate on what it actually takes to achieve a 16.5% capacity growth.
Because we are looking at a transcript from mid-2026 here. And the sources point out that for the last several years, global supply chains have been an absolute mess.
Oh, completely. Getting new airplanes from manufacturers like Boeing has been a notoriously delayed, frustrating process for almost every carrier on Earth.
Yeah, you don't just snap your fingers and add 16% more flights to a global schedule.
You certainly don't. I mean, for years, airline management teams have been forced to artificially constrain their growth.
Because they had the routes planned and they had the passenger demand, right?
Yes, but they simply could not get the physical metal delivered to the tarmac.
So what makes Copa's situation distinct here?
Well, CEO Pedro Heilbronn explicitly pointed out that their deliveries from Boeing are not only arriving on time, but in some cases they're actually arriving a month early.
Wait, a month early? From Boeing? In this environment?
I know, it's wild. During this specific second quarter, Copa took delivery of 4 new Boeing 737 MAX 8 aircraft.
Okay, let me play devil's advocate here for a second. Taking delivery of 4 planes is great, but getting the planes is really only half the battle, isn't it?
It is. It's just the starting point.
Right, because to grow capacity by 16.5%, you have to hire and train the pilots to fly those specific planes.
Yep, and you have to secure gate space at destination airports.
Exactly. You have to scale up your baggage handling, your maintenance crews. I mean, it's a massive logistical heavy lift.
It is an immense operational burden. And honestly, that is exactly why this capacity metric is so impressive.
Because it proves they were ready.
Exactly. It proves that Copa didn't just get lucky with Boeing's delivery schedule. Their internal operations were entirely synced up to absorb that new metal the second it touched down in Panama.
They had the flight crews trained, the schedules optimized, the marketing engines running to sell those seats.
Growing your capacity by 16.5% in a single year, especially in a macro environment where competitors are still hobbled by supply chain excuses, is a decisive operational victory.
But, and this is a big bold, despite that massive victory, despite successfully filling a much bigger restaurant, we are still looking at that 54% drop in net profit.
Yeah, we have to talk about the absolute elephant in the room, the fuel shock.
The fuel numbers in this quarter are just staggering. They are the entire reason the bottom line shrank while the top line grew so much.
The all-in jet fuel price for Copa surged an astronomical 84.8%.
Or basically 85%.
Pretty much. In the second quarter of 2026, they were paying $4.28 per gallon.
Okay, to put that in perspective for you, in the exact same quarter the prior year, they were paying just $2.32.
It's almost double. Think about your monthly gas budget for your car. Imagine if it literally doubled overnight.
It would be incredibly painful.
Now imagine you are operating a fleet of 131 commercial jets flying all across the Americas. It is a catastrophic expense increase.
The transcript shows that this fuel spike drove their total CASM, which stands for cost per available seat mile, up by 26%.
So total CASM is essentially the total cost to fly one seat 1 mile. And a 26% jump in that unit cost is a brutal hit.
But here's where it gets really interesting. This is the crux of the entire earnings call.
Yes, the single metric that separates a well-run airline from a failing one.
Right, their ex-fuel CASM. That is the cost to fly one seat 1 mile when you group out the price of fuel.
And despite the absolute chaos in the commodities market, Copa's ex-fuel CASM remained completely flat at 5.7 cents.
Wait, flat? It didn't go up at all.
Not even a fraction of a cent. 5.7 cents. Perfectly flat.
That's incredible because, I mean, fuel is largely out of an airline's control, right? It's traded on global commodities markets. It spikes based on geopolitical tensions.
Exactly. But everything else, labor, maintenance, airport landing fees, corporate overhead, those are all considered your controllable costs.
So Copa grew their entire operation by 16% in an era of rampant global inflation, and their controllable unit cost didn't budge at all.
We really have to dig into the mechanism of how that is even mathematically possible. Maintaining a flat ex-fuel CASM of 5.7 cents is basically considered the holy grail of airline management.
Because usually when you grow a network that aggressively, inefficiencies creep in, right?
Yeah, you have to hire more staff, perhaps pay overtime, open new stations at new airports. It usually drives costs up.
So how do you keep the unit cost flat?
It all comes down to economies of scale and just ruthless asset utilization.
Okay, explain that mechanism for me. How does growing larger actually keep the unit cost flat?
Think about the fixed costs of running an airline. You have a corporate headquarters in Panama. You have executive salaries, IT infrastructure, a massive core maintenance facility.
Right, those are fixed. They don't change whether you fly one plane or 50.
Exactly. So if you fly 100 planes, those fixed costs are spread across a certain number of seats. But if you take delivery of more planes and increase your total seat miles by 16.5%,
you are now dividing those exact same fixed corporate costs by a significantly larger number.
bingo, the cost per seat naturally goes down. But simultaneously, you have inflation driving up the variable costs like labor and ground services.
Ah, I see. So what Copa managed to do was perfectly balance those two scales.
Yes, they used the efficiency of their massive growth to perfectly offset the inflationary pressures of the broader economy. It's brilliant.
Okay, I follow the logic on the controllable costs. That makes sense. But I have a really serious question about how they handled the fuel spike itself.
Let's hear it.
So the financial summary notes that they only had a fuel recovery of 40%, meaning they only managed to recover 40% of that massive fuel cost increase through higher ticket yields.
Right, the passenger yields didn't cover the whole gap.
So if management saw fuel prices spiking so drastically, why didn't they just raise ticket prices across the board to cover the gap? Did they just miscalculate?
It is the most logical question to ask, and an analyst actually pressed CEO Pedro Halbron on this exact point during the Q&A session.
And what was his defense?
The answer reveals a fundamental reality of airline economics. It's all about the mismatch in timing between when a ticket is sold and when the expense is actually incurred.
Oh, I see where this is going.
Heilbronn explained that approximately 40% of the quarter's bookings were already sold and paid for long before the fuel price surge ever materialized.
Right. If I buy my summer vacation ticket in February, I lock in my price.
Exactly.
So if the price of jet fuel triples in April, Copa can't just call me up and demand another $200 at the boarding gate.
Precisely. An airline cannot retroactively charge passengers for a macroeconomic shock. So roughly 40% of their entire inventory for the quarter was locked in at prices modeled on $2 jet fuel, not $4 jet fuel.
But wait, if they know fuel is this volatile, why don't they just hedge their fuel? I mean, other airlines buy financial derivatives to lock in fuel prices months or years in advance, right?
Yeah.
To prevent exactly this kind of 85% shock. Are they just gambling on the spot market?
So hedging is incredibly complex, and frankly, it's highly controversial in the airline industry. You are right, some carriers hedge heavily.
But Copa doesn't.
Well, hedging is basically an insurance policy, and the premiums for those derivative contracts are incredibly expensive.
I see. It eats into your margins even in good times.
Exactly. Furthermore, if you lock in a high price and then fuel drops significantly, you are trapped paying above market rates.
Oh, and then your unhedged competitors enjoy the cheap fuel and use it to undercut your ticket prices.
Exactly. Many management teams, including Copa's, often prefer to rely on their operational efficiency and a fortress balance sheet to absorb the shocks, rather than paying millions to Wall Street banks for hedging contracts.
And honestly, the proof is in the pudding here. The fact that they absorbed an 85% spike in their primary cost, while nearly half their inventory was underpriced.
And they still walked away with nearly $92 million in operating profit. It's mind-boggling.
If their controllable ex-fuel cost had risen alongside fuel, this quarter wouldn't have just been a margin compression. It would have been an absolute financial bloodbath.
It really highlights how tight the margins for error are in this industry. They absorbed the blow on the tickets they had already sold, and then they aggressively raised the passenger yield by 8.7% on the remaining 60% of tickets.
So they tried to plug the hole as fast as they could.
Yeah, it was a rapid, tactical pricing adjustment on the fly, and that's what kept them in the black.
But fuel wasn't the only external shock they had to deal with. We also have to look at this incredible anecdote from the call regarding human behavior.
Oh, this is one of my favorite parts of the transcript.
The numbers show that Copa's overall load factor, which is the percentage of available seats that are actually filled with paying passengers, dipped slightly for the quarter.
Right. It dropped to 86.7%, down from 87.3% the previous year.
And the executive vice president, Robert Carey, explicitly pointed out what happened. He blamed the World Cup.
The intersection of global sports, national pride, and airline logistics. It is just a fascinating behavioral anomaly.
Right. Carey noted that specifically in the month of June, their load factor dropped 2.3 percentage points year over year.
And in the airline industry, losing 2.3 points of load factor in a single month is a very, very noticeable dip.
It created a 0.1 cent drag on their revenue per available seat mile, their RASM.
It's an amazing data point because the drop didn't happen because of a structural flaw in Copa's pricing. It didn't happen because the economies of Latin America suddenly stalled out. It was a purely cultural and behavioral shift.
People across the region simply stayed home to watch the football tournament.
Instead of taking a normal summer vacation or booking a routine business trip, they just parked themselves in front of the television to watch the knockout stages.
It perfectly illustrates the limits of operational control. You can have the most efficient network, the newest planes, the best pricing algorithms in the world.
But if half a continent collectively decides they don't want to fly for 4 weeks because their national team is playing, your planes are going to take off with empty seats.
Airlines are entirely at the mercy of macro-human behavior sometimes.
But the critical piece of the puzzle here isn't that demand dropped. It's how violently it bounced back right after.
Yeah, this was purely a June anomaly. Carey provided evidence of an immediate recovery, noting that by July, traffic rebounded with an absolute vengeance.
They hit a load factor of nearly 90% in July. And remember, that 90% load factor is occurring on a capacity base that is 16% larger than the prior year.
That July metric is the ultimate vindication for management. It proves beyond a shadow of a doubt that the underlying consumer demand was merely paused, not destroyed.
Exactly. If that June drop had been a canary in the coal mine signaling a regional recession, July would have been just as weak.
But the passengers who delayed their trips in June clearly just rebooked for July. It gave Wall Street the confidence that Copa's core network was fundamentally healthy.
Speaking of their core network, we really need to dive into the architecture of Copa's business model.
Because everything we've discussed so far, the ability to fill those seats, the ability to pass on price increases, it all relies on what I can only describe as massive strategic moat.
Copa's geographic position is arguably their greatest single asset.
They operate the hub of the Americas out of Panama City, and they are in the process of supercharging it.
Right. Tocumen International Airport in Panama City acts as the literal crossroads for intra-Americas travel.
So if you are flying from Buenos Aires up to Montreal or from Bogota across to the Caribbean,
routing through Panama is almost always the most direct, efficient path. It bypasses the congestion of North American hubs like Miami or Houston completely.
And during this call, they announced a massive operational shift to leverage that geography even further. In March 2027, Copa is going to transition its Panama City operations from 6 connecting banks to 8 connecting banks.
They also announced a new destination, Porlamar, in Isla Margarita, Venezuela, which makes it their 88th destination, by the way.
But the truly revolutionary news is this shift from 6 to 8 banks.
We really need to break down the mechanics of this because the connecting bank strategy is the fundamental heartbeat of a hub-and-spoke airline model.
Right, let me use a visual analogy here to explain what a bank actually is. The glossary gives the technical definition, but visualizing it makes the genius of it obvious.
Go for it.
Imagine a massive central train station. A bank is essentially a highly coordinated, incredibly intense rush hour.
Okay, I'm picturing it.
Imagine 50 trains from all over the country arriving at the station at exactly 1 p.m. The doors open, thousands of passengers pour out, they frantically swap trains.
And then all 50 trains leave the station simultaneously at exactly 2 p.m.
Exactly. That perfectly orchestrated arrival, transfer, and departure window is one bank. Currently, Copa choreographs this massive mechanical ballet 6 times a day in Panama.
Am I moving from 6 to 8 banks? They are essentially adding 2 entirely new, massive rush hours to their daily schedule.
The primary benefit to the passenger is connectivity, right? It drastically increases the number of connection combinations available.
Yeah, if you miss a flight or you want a slightly different schedule, you don't have to wait 4 or 5 hours for the next major bank. There is another rush hour right around the corner.
But here's where I have to push back, and it's actually exactly what analyst Mike Lindenberg brought up during the Q&A.
It's a very valid concern.
This sounds like an absolute logistical nightmare for the airport. Won't adding more flights and entirely new rush hours just completely suffocate the existing infrastructure?
Right, like, does Panama even have enough physical gates, tarmac space, and runways to handle 8 massive influxes of planes instead of 6?
Exactly. When you hear, we're adding 2 more rush hours, you immediately picture gridlock.
But the response management gave to Lindenberg reveals the counterintuitive brilliance of the strategy. Moving to 8 banks actually spreads out the traffic.
That doesn't track for me. How does adding more flights to a daily schedule spread the traffic out?
Think about the physical constraints of the airport. If you are restricted to only 6 banks a day, every single new flight you add to your network has to be crammed into one of those 6 existing windows.
So the peaks of those rush hours get taller and taller.
Exactly. You need more physical gates simultaneously. You need more baggage handlers simultaneously.
Okay, I'm starting to see it.
But by creating 8 banks, you take the total daily volume of flights and you distribute them across more hours of the day.
So the individual peaks actually shrink slightly, or at least stabilize, while the overall daily volume of planes moving through the hub increases.
Precisely. It is an efficiency play disguised as an expansion play.
That's brilliant. By adding the 2 extra banks, you don't necessarily need to pour millions of tons of concrete and build 20 new gates immediately, because you are just using the existing gates more frequently and more evenly throughout the day.
Exactly. The business lesson here for anyone listening is all about asset utilization. Before you spend billions expanding your physical footprint, you have to ask if you can simply re-choreograph how you use your existing space.
This 8-bank shift increases the daily utilization of the aircraft too, right? Meaning the planes spend less time sitting idle on the tarmac waiting for the next massive bank.
Yeah, and it optimizes the existing airport infrastructure. If we pull back and look at the macro picture, this move heavily reinforces Panama's dominance.
Because for a competitor to try and replicate an 8-bank schedule with 88 interconnected destinations in Latin America,
it would take decades of relationship building and billions of dollars in capital. This isn't just an operational update. It is Copa deepening a strategic moat that makes them virtually unassailable in that specific geography.
They are extracting significantly more value out of the exact same physical space. It's just brilliant.
And while they are optimizing operations on the ground, the transcript shows they are also heavily investing in the technology in the sky.
Let's talk about fleet flexibility and how they are elevating the passenger experience. We mentioned earlier that they have a current fleet of 131 aircraft, and they are taking steady deliveries of the 737 MAX 8s.
But they made a huge announcement regarding onboard technology that we definitely need to highlight.
Yes, the rollout of Starlink internet. Copa operated its very first Starlink-equipped flight in July of 2026.
This is a massive milestone because it makes them the absolute first carrier in Latin America to offer this specific high-speed, low-latency connectivity.
The transcript notes they expect the full fleet of 131 planes to be installed by the first half of 2027.
And the logistics of that are fascinating, right? You have to take planes out of commercial service, put them in a hangar, open up the fuselage, install the radome receiver on top, wire the entire cabin, and test it.
All without disrupting your 16% capacity growth. It's a massive undertaking.
It is, but the payoff is a distinct competitive advantage. And the business model they chose for it is highly strategic.
Right. It's a complimentary, free service for their premium tier passengers, business class, gold, platinum, and presidential frequent flyers.
It is also free for passengers who already have a home Starlink subscription. Everyone else pays a fee.
It's a massive upgrade to the value proposition for the passenger. I mean, if you're flying over the Amazon rainforest or the Caribbean Sea, traditional satellite Wi-Fi is usually spotty, slow, and infuriating.
Oh, it's the worst. So offering true high-speed streaming capability at 30,000 feet really drives loyalty among premium business travelers.
And those premium travelers are the highest margin customers an airline has. Keeping them happy is paramount to the bottom line.
And while we are on the topic of investments in aircraft, we need to address a specific financial detail that sparked a lot of discussion during the analyst Q&A.
Yes. It's regarding capital expenditures, or CapEx.
The CFO, Peter Donkersloot-Ponce, noted that their full-year CapEx guidance was adjusted down by $50 million, dropping to a range of $700 to $750 million.
And Wall Street analysts scrutinized these tweaks heavily, right? I have to ask about this because a $50 million drop in capital expenditure sounds like a huge deal.
It sounds like it, yeah.
Does a sudden $50 million reduction mean they are pulling back on investments? Is it a warning sign about the health of the business?
This is a perfect example of why you can't just read a headline number on a financial summary and panic. You have to understand the accounting mechanics.
Okay, so what's the real story?
The CFO explained very clearly that this $50 million reduction has absolutely nothing to do with cutting investments or a lack of capital. It is entirely due to a single Boeing aircraft delivery shifting from late December to early January.
Wait, really? So the plane is literally just arriving 2 weeks later than planned?
Yes. And because it arrives in January instead of December, the massive cash outflow required to actually pay Boeing for the plane shifts from the 2026 fiscal year into the 2027 fiscal year.
So it is purely an accounting quirk based on the calendar.
Entirely.
And crucially, that 2-week delay has zero impact on their operational flight capacity for 2026, because a plane delivered in the last week of December wouldn't have been fully integrated in flying passenger routes until the new year anyway.
Exactly. It's not a canceled order. It's not a cash crunch. It's just the reality of delivery logistics straddling a fiscal boundary.
Good to clarify that. And looking further ahead regarding the fleet, CEO Pedro Heilbronn discussed their strategic flexibility looking out to 2028.
This is where the long-term planning really shines. He noted they have 11 lease expirations coming up, and they also have over 40 unencumbered aircraft.
Let's define that term for the listener. Unencumbered aircraft means planes that the airline owns outright. They're entirely free and clear of any bank debt or leasing obligations.
Right. No monthly mortgage payments on those planes.
And having 40 of them is a massive strategic lever. Explain how that specific mix upcoming lease expirations combined with a huge fleet of unencumbered owned planes acts as a tool for management.
Think of it as a financial dial that management can turn based on exactly what the macroeconomy is doing in 2028.
Okay, so if the global economy is booming, travel demand is red hot, and fuel is cheap.
They simply renew those 11 leases, keep flying their 40 owned planes, and absorb all the new Boeing deliveries to grow their network aggressively. They turn the dial all the way up.
But what if the opposite happens? What if there's another massive fuel shock or a deep regional recession?
Then they turn the dial down. They simply let those 11 leases expire and hand the keys back to the lessors without any financial penalty or complex bankruptcy restructuring.
Wow, so they instantly shrink their physical capacity and shed a massive monthly fixed cost.
Exactly. And because they have those 40 fully paid off unencumbered planes, they can operate a smaller, tighter network with incredibly low fixed costs.
It provides ultimate downside protection in an industry that is famous for catastrophic downsides.
Which perfectly transitions us to the foundational strength of the entire company, the fortress balance sheet.
When you read the summary of Copa's financials, fortress is really the only word that adequately applies.
It really is. Let's run through these core numbers because they are genuinely shocking for an airline.
They ended the quarter sitting on $1.5 billion in cash and investments. That number represents 39% of their last 12 months of revenue.
Let that statistic sink in for a moment. They hold nearly 40% of their entire annual revenue in highly liquid cash and investments.
So what does this all mean for the health of the company? Let's translate this into personal finance terms to make it relatable for you.
Good idea.
Imagine you make $100,000 a year in salary. Having Copa's balance sheet means you have $39,000 sitting in a liquid, easily accessible checking account at all times.
It is a phenomenal emergency fund. It is the ultimate sleep at night money.
And then you look at the liability side of the ledger, their debt. Their net debt to EBITDA ratio is 0.9x.
Now, in the airline industry, which is absolutely infamous for highly leveraged bankruptcies, where legacy carriers routinely carry debt ratios of 3, 4, or even 5 times their earnings.
Operating at 0.9 is just staggering conservatism.
It is, and their total absolute debt is approximately $2.7 billion. The CFO explicitly noted that this debt is almost entirely related to aircraft financing.
And here's the absolute kicker. The average cost of that debt is 3.7%.
So continuing your personal finance analogy, this means not only do you have a massive cash emergency fund,
but the only debt you hold is the mortgage on your house, your airplanes, And you managed to lock in an incredibly low 3.7% fixed interest rate before global rates spiked.
Exactly. They are not burdened by high-interest revolving corporate credit or toxic variable rate junk bonds.
And this impenetrable financial armor is exactly what allows them to reward their investors while their competitors are just struggling to keep the lights on and pay for fuel.
Right. During the call, they announced a quarterly dividend of $1.71 per share.
On top of that, they have already executed $45 million in share buybacks out of a $100 million authorization, which leaves them roughly $60 million left to deploy.
Think about the signaling there. A company buys back its own stock when management believes the market is undervaluing the company's future cash flows.
To aggressively return capital to shareholders via dividends and buybacks in the exact same quarter where your main operational expense jumped 85%.
It is the ultimate proof of their structural resilience. They didn't have to suspend the dividend or halt the buybacks to pay the fuel bill. The balance sheet was strong enough to absorb the shock entirely on its own.
Which brings us to the final piece of the puzzle, and arguably the most optimistic part of the entire earnings transcript.
Management's forward guidance. The skies ahead look incredibly clear for Copa.
They actually raised their full-year operating margin guidance to a range of 17 to 19%. They also raised their capacity growth guidance to 14 to 15% for the year.
And crucially, the macro environment is finally giving them a break. Their full-year fuel price assumption dropped to $3.60 per gallon.
Now, that is still elevated compared to the historic lows of the prior year, but it is a massive, significant cooling off from the $4.28 they suffered through in Q2.
Absolutely. But I have to ask the obvious mathematical question here. If their Q2 margin was dragged down to only 8.7%, and they are now guiding the market to expect 17 to 19% for the full year,
how on earth are they going to drag the annual average up that high?
Exactly. The second half of the year has to be mathematically explosive in terms of profit to make that average work.
It absolutely does. And the math relies on three very sturdy pillars. First, as CEO Pedro Heilbronn noted, the first quarter of 2026 was a massive record breaker for them.
Right. So they entered Q2 with a very high average margin already banked.
Second, fuel is projected to drop by nearly 70 cents a gallon for the remainder of the year.
And third, and most importantly, ticket yields, the actual price passengers are paying for seats, are remaining historically high.
Right. Robert Carey noted that for the second half of the year, they are seeing a forward-looking trend of plus 10% on RASM, the revenue per available seat mile.
And as of the August call date, the third quarter was already 75% booked.
They already have the cash in hand for 3/4 of their Q3 flights at these elevated ticket prices.
Exactly. And this is where CEO Pedro Heilbronn's comments on the broader market's competitive pricing become the absolute linchpin of the bullish thesis.
An analyst asked a very pointed question, essentially saying, look, if fuel prices are dropping across the board, won't all the airlines just start a massive price war?
Right. Won't everyone slash ticket prices to steal market share from each other?
The classic race to the bottom. It happens in retail all the time.
It does. But Heilbronn noted that the Latin American aviation market is currently showing profound discipline.
You have to look at the history here. Pre-crisis, yields in the region were actually depressed. They were below 2019 levels.
The massive fuel shock of Q2 essentially forced every surviving airline to raise prices just to stave off bankruptcy.
Now that fuel costs are dropping, the airlines aren't immediately giving those margin gains back to the consumer. They're holding the line on ticket prices.
Which creates a beautiful scenario for Copa. If the ticket prices stay high and the fuel costs drop significantly, that entire widening delta falls straight to the bottom line as pure operating profit.
They suffered through the fuel spike with low-priced legacy tickets in Q2, but now they are perfectly positioned to reap the massive rewards of falling fuel costs combined with high-priced tickets in Q3 and Q4.
It perfectly sets up the second half of 2026 to be vastly more profitable, hence their extreme confidence in projecting a 19% potential full-year margin.
It is an incredible financial turnaround story contained within a single fiscal year. So let's recap the major takeaways for you as we wrap up this deep dive.
We've examined the underlying mechanics of how Copa Airlines survived an 85% fuel shock. It wasn't magic.
No, it was achieved by ruthlessly maintaining a flat 5.7-cent non-fuel cost basis through sheer economies of scale.
We saw how they absorbed a bizarre World Cup behavioral anomaly and bounced right back the very next month.
We unpack the logistics of how they are creatively expanding their Panama hub from 6 to 8 banks.
They're squeezing massive operational efficiency and better asset utilization out of existing concrete rather than just pouring billions into new infrastructure.
And they're executing all of this strategic growth while sitting on a fortress balance sheet, holding a mountain of cash, maintaining incredibly low leverage, and actively paying out healthy dividends.
It is a definitive masterclass in building operational leverage.
All of this analysis raises an important question, and it's a final thought I want to leave you with to ponder based on everything we've synthesized today.
Let's hear it.
As Copa transitions to this ultra-efficient 8-bank hub by 2027, and as they roll out high-speed Starlink across their entire fleet to lock in the absolute most lucrative premium passengers, one has to wonder.
Wonder what?
In a macro environment where new airplanes are increasingly hard to come by and global supply chains remain incredibly fragile,
Will Copa's absolute geographic monopoly in Panama, combined with their massive fleet of unencumbered aircraft and 0.9 leverage ratio, make them essentially impossible for legacy carriers or new budget airlines to disrupt?
they aren't just surviving the turbulence we see in the market today. They appear to be methodically building an airline that is structurally immune to it.
That is a deeply fascinating strategic question to ponder, because when the diagnostic picture of the global airline industry looks murky and chaotic for almost everyone else, Copa seems to have a perfectly clear, highly profitable picture of exactly where they are going.
Thank you for taking the time to join us for this deep dive into Copa Airlines' Q2 2026 results. We hope you've extracted some valuable blueprints for operational resilience. Keep learning, keep questioning the numbers, and we will catch you on the next deep dive.